welcome to our webinar today. And I unfortunately, for whatever reason, don't have my visual on, but you can hear my voice. It's Gayle Peterson, and I direct the Social Finance and Impact Investing Program. I also want to let you know I've got COVID. So today is one of those days where things are not going exactly as I planned. But we've got a fabulous session, and I'm going to do a little bit of an introduction into social finance, how it differs from our impact investing program, and what you're going to learn through the program, which starts in September. And then I'm going to turn it over to Jenn Pryce, Najada Kumbuli, who's got the most wonderful name in the world, very melodic, beautiful, and who is going to join us today and really talk about what blended capital means. When we think about COVID, the irony is that I caught it even being vaccinated, is building back better. How do we become more resilient? How do we rethink capitalism? How do we rethink how we package capital to create profound, resilient communities? And that's really what the program is about. And we take you from all aspects of capital, from philanthropy to impact investing. We talk about traditional finance, development finance institutions, what they have to contribute, and how you put those pieces together in a puzzle that allows you to achieve long-term scalable success. Our program involves students from around the world, and it is unique in several ways. Not only do we have a vibrant global network, but we have a CEO leadership program. So your faculty members are typically CEOs. And we do that because they can speak honestly about the challenges they face. We are going to be doing an experiential learning process similar to what we've done in impact investing, where you and members of your cohort will take a real-time, real-life problem and tackle it and put together a blended capital prototype and model. So it's an opportunity to not only learn academic theory, practice with successful practitioners in the field, and also test your own skills in negotiation, in partnership building, in understanding how to work with community. So, and measure impact. Those are just some of the things you're going to learn on the program. Again, it's I do these slides because I want to remember where I need to be in September. I'm actually going to be in Oxford if all goes well. With our team. It's a virtual program, but it'll be nice to be back at the business school. And again, I think what makes the Said Business School unique is that it really is devoted to creating programs that address the most difficult problems facing our world. Social finance is in a nest of impact programs in our portfolio. And for me, social finance, again, is the only one of our programs that addresses blended capital in a robust way, moving, again, from philanthropy to traditional finance and all points in between. Impact measurement, again, is a deep dive into how you measure success, outcomes, and developing your own theory of change. Impact investing is really focused on deal making. It touches a little bit on blended capital, but it's really a 101, and impact finance innovations is really focused on technology and new approaches to impact finance. So it's the cluster. We started with impact investing almost 10 years ago. We're celebrating our anniversary, 10-year anniversary next year in March. But social finance is now, I think, Layla, 4 years old. And it's been a joy. What I've watched with the social finance program is really our students have come away with action. They've had profound impact on the world, from conserving the Amazon, to generating new economic opportunities for women and addressing gender inequality, in climate through climate migration practice, changing public policy, and really creatively looking at how to go to scale across the world. It's a remarkable experience. And Layla will talk more about the programs and how you can sign up after the session. Again, blended finance works across the ecosystem, and we're going to give you some numbers to play with, understand how we approach this work, and this is the spectrum in which we're going to be negotiating those deals, again, through practice and innovation. So that's, again, the summary of what we focus on and how we approach our work. We look at all stages of development, typical sources of funding, investor type, and role of investor, putting the community at the center and surrounded by the SDGs, Sustainable Development Goals. We use a wicked problem framework. How do we address intractable issues, seemingly intractable issues? How do we use capital to drive a new purpose and new solutions? The panel speakers, you've got smiling faces here. Jenn's going to lead this conversation, and I'd like you to use the chat function or question function. Send us anything you'd like to chat about. Again, our approach to webinars is really to have you be actively involved in the discussion. And I love the fact that I'm sharing my screen and I have no idea why this is popping up. There you go. It's been one of those days. So with that, Jenn, I'm going to turn it over to you and stop sharing my screen and let you take over.
Wonderful. Thank you, Gayle, and thank you for that kind introduction. I am going to bring my screen up, so I'm just going to take a moment and get the right document, and it's at the end of the presentation. Always good when you start at the top. Let me bring it all the way up here, get it up set. Are you seeing it now, the presentation?
Yes, but you need to go full screen.
Okay, thank you. Let me just get that. All right, we should be in business now. Yeah, is this good?
Yep,
thank you.
Good.
All right. So as Gayle mentioned, I'm Jenn Pryce, and Najada Kumbuli is here as well. She'll be coming in, and we're going to share a slide deck. And so we have one slide deck that we're going to walk through and share it. And that's in the theme of the title you see here, partnership. You see it twice in this title, Creative Capital Partnerships, Building Powerful Partnerships Across the Impact Finance Ecosystem. And how we're sharing this deck is illustrative of how the work gets done when we're thinking about public-private partnerships using blended finance strategies to really bring multiple stakeholders together. We'll introduce ourselves first, so you'll see what perspective we're bringing to this conversation. And then we have a little bit of a how does this all fit together? Capital, the SDGs, and the ability to get capital into community where traditional finance does not reach today. And then because Najada and I have been doing this for quite a number of years now, over a decade each of us, we thought we'd share a little bit of the lessons we've learned from being at the table, putting these multiple stakeholder relationships together, some takeaways we've had at a high level. And then we're going to go a little deeper and share a transaction with you that we both worked on. We came in with different roles to play. As you'll hear from our perspective, we sit in different places of the finance ecosystem, and we can share a little bit about how we came into that transaction and why it worked for us. And then, of course, as Gayle said, we'll have time for questions. So with that, just a little bit about me. I've been teaching, as Gayle mentioned, in the courses Social Finance and Impact Investing for a handful of years now, and have been really excited about watching the students come in, really deeply engage with this content. And because I'm a practitioner, what I'm bringing is real world examples, real time advancements in the field. And that has been a real joy to be working and learning from the students as I'm presenting real time what we're learning at Calvert Impact Capital. Calvert Impact Capital, we're based in Washington, D.C., but we're a global firm. We're an impact investing intermediary. We raise capital, private capital from the markets. And that's kind of one of the stakeholder lenses I bring here, is bringing private capital into impact transactions. Importantly, where we'll be focusing a lot of this conversation on is in the third bullet down. You can see we've anchored dozens of landmark transactions. It's those transactions that are listed there that are all public-private partnerships. They all employ blended finance strategies. It's how we're able to move private capital into community in the shape and form that community needs, which is ever so vital. Is we need the capital to work for the community, but also meet the demands of the investor. And so we've been at this work for over 25 years. And in that time, we've really created a stronghold in getting products to market, providing more on-ramps for investors, and also being a leader in impact management and measurement. So if that also becomes questions, I'm happy to answer any of those. Najada?
Thank you, Jen. If we can go to the next slide very briefly, I'll speak to it. And as Jen said, the reason why we're excited to be doing this deck together in this presentation is to really highlight the importance of collaboration and collaboration among different capital providers. So very brief overview of Visa Foundation. Visa Foundation, unlike Calvert Impact Capital, has a very short, time period that it has been in operation, only a couple of years old. But we find ourselves to be in a very unique position, particularly as a corporate foundation. Our goal is to align 100% of all our assets, so the entire endowment, for impact. And as I mentioned, as a corporate foundation, that is relatively unique in the sense that we have a corpus, we have an endowment that primarily focuses on strategically combining both grants and investments to challenge systemic barriers, really champion solutions that are able to scale. In simple terms, our goal is to really think about how can we break the traditional barriers that exist between grant making and investments, and how can we address any issue holistically and think about which type of capital is most useful in under what circumstances. The other thing that I'll share is that like from a foundation perspective, we're relative, and as a global foundation, we are relatively small. We have slightly over $500 million of assets under management, and as a result, our focus, unlike, for example, Calvert Impact Capital, that has a broader mandate, invest across sectors, we have. Mission and vision is primarily focused on the intersection of between small businesses and gender equity. Happy to share more about the foundation, but would love to get deeper into the transactions, as that really illustrates a little bit more the work that we're doing in coordination and collaboration with other partners like Calvert. Thanks, Jen. Over to you.
Okay. So next slide, these next two slides are just setting context of why partnership is so vital, why we need private capital at the table, but why it's so important to have also philanthropic, as Najada highlighted in her what Visa Foundation does, as well as public resources. And so at the top level, just connecting from where Gayle was with the SDGs and rethinking capitalism, repackaging capitalism, this is the top line. Many people have seen this, but just to reiterate, if you have, and if it's new to you, this is the state of our reality. Down in the lower right, what we know is that we need at least $6 trillion annually to be invested to reach the goals set out by the Sustainable Development Goals. And what we also know is the last 12, 18 months has put enormous pressure on many communities, and it continues to do so. And so I would argue that that's probably a number that's even greater now, because we have, in fact, fallen behind in some ways due to the economic fallout from COVID. What we also know is the global giving is just not a great enough amount of capital to meet that need. And we also know that government budgets are stretched, that they aren't growing, and they're not going to be able to meet that need of $6 trillion annually. So what we're looking at is really tapping the capital markets, private capital, which is in fact much bigger than 75 trillion. This is a slice of the capital markets of actively managed accounts, and it's about a year old, so it's even up now to more like 100 trillion. And it's really that capital that we're looking to unlock and to bring into transactions that traditional capital does not finance today. And so this is one half of the equation. The other half of the equation, which is where Najada was highlighting and plays really deeply, as do we at Calvert Impact Capital, is really getting impact markets ready and poised to bring in private capital and scale. And as Najada mentioned, Calvert Impact Capital has been lending and investing across geographies, over 100 countries and over 9 impact sectors for the life that we've, for our entire existence, so over 25 years. And we've seen some patterns. And what this slide is sharing is the patterns we've seen in how impact sectors grow and scale. And what we've seen is, starting on the left side, that seed stage impact sectors, nascent impact sectors, think here perhaps the blue economy or some of the sustainable agriculture sector work. And then on the right, you see fully scaled impact sectors. So you can think here potentially microfinance in some markets, perhaps community development, affordable housing in some markets. But those are the polar opposites. In the middle, you see the evolution phases of early growth and testing scale. And what we've also seen as you go down the left, the donor role, the private impact capital role, and the public role, is we need different types of capital play different types of roles as we evolve these sectors. So move them from the seed to the fully scaled side. And as you can see in the donor role, for example, there is a need for higher philanthropic resources in the seed stage. You can see that by the shaded gray triangle that's at its peak in the seed stage and then slowly declines over the life to fully scaled, because we need a lot of risk capital to do R&D innovation, test new markets and business models. As we move over to fully scaled, you can see the private impact capital role increases as we begin to really test capacity and scale and really begin to hand off to the commercial markets. And I think what's really interesting, and very honestly for me in my journey with impact investing, is the public role. You can see it's shaded the whole way out. We need public resources, we need public regulation and incentives. So different ways that the public role shows up, but we need the public through all these phases of growth and development. And again, as I was saying, for me, that was a big aha moment, to see that you really still need the public role very strongly as you test and you hand off to commercial markets to ensure that you get the right regulation, the right incentives baked into the market. And so the good, the impact, the community voice continues to carry through, even through scale. Najada, shall I pass it to you to see if you wanted to overlay any thoughts here or any comments from the perspective?
Yeah, I would. Yeah, thank you, Jen. I appreciate that. I would echo, specifically speaking from Visa Foundation's perspective as a donor and as a grant maker, not wearing my impact investing hat. It is important. What we have as a team, what we have communicated to the board and to the number of stakeholders is that the amount of grant making that we can make is a small sliver of the total endowment that the foundation has. So it is really important to think about how can you use that really precious, to a certain extent, pool of capital to accelerate the type of impact that we want to see. So as you had shown there, the most important aspect for grant making that ties to the investment as it relates to the different stages of growth is that early seed stage. And it can take a variety type of, kind of like roles and nuances, whether it can be, financing accelerators to support more women-led type of companies, or whether it is to your point, to testing new models. We do need more grant makers and donors to really think about how can they utilize as best as possible grant resources in order to think about the multiplier effect that it can have in getting the solutions to scale. And I think it complements well if we think about a number of the foundations and other type of, like philanthropic players that are then utilizing both grants and investments, and, how that can support further their investment activity.
And just, using now this slide to bridge to some of the lessons we've learned, and just taking what Najada emphasized, the donor role, the precious capital, and needing to think about using that as a fulcrum for scale. What you're looking at here, and it's that second circle up at the top, is what's going on in here is a lot of blending, a blending of philanthropic, private, and public capital. So this is the beauty of blended finance, is really moving private capital into the fully scaled, into the testing scale, into the early growth, less into seed stage, just because it is so risky and private capital isn't quite ready to be there. And so there is a need for more donor capital. But this has been the work of all the blended finance transactions that we've seen in the market, is really moving impact sectors to scale. And what we wanted to share now is just, as I mentioned at the top, from being in these markets for so long, lessons that we've learned. We talked before, and these were 3 lessons that came to us. Najada might add more at the end, but I'll just walk through these 3 and then pass it back to her. But one lesson is iteration. Iteration being, don't let the perfect be the enemy of the good, if that's a phrase you've heard. And so that means at times getting a transaction done, knowing it isn't quite exactly what we wanted to get to, because we want to get to market, we want to get the capital into community, and we want that to be a demonstration and be able to go back and evolve the transaction to then meet the market fuller or more appropriately the next time. But what we've seen is iterating and learning from prior transactions is a vital lesson. And the example here on the right, I'll just touch on quickly. It's the DC Water Environmental Impact Bond. We at Calvert Impact Ca actually just got repaid on this investment early in May. It was a 5-year bond we purchased, and it was the world's first environmental impact bond. Last week, they closed the world's 4th. So, over 5 years, we've only done 4 of them. However, each of those bonds evolved the market, evolved the ability to finance green infrastructure in a material way. And the last bond that was closed in Buffalo, New York was for $54 million. So they've also grown in size. The first one was only $25 million. But this is just one of the lessons we've learned, is iteration. The second one is to be honest, and this is being honest about what kind of capital you need when, and what role you play in the ecosystem. Something that Najada was highlighting very clearly on that slide earlier, and something that we saw at Calvert Impact Ca really clearly through the world's first blue bond. It was the issuance of the Seychelles government. And what was critical here is the blue bond that we purchased came after about 25 million of philanthropic investment over multiple years. And it was all that philanthropic investment that made the blue bond happen, that made there be an investable transaction. And so the be honest part is, at times investment is not the right tool in the toolbox. it does need philanthropy, and knowing when to use philanthropy and when to use investment, back to what Najada was saying, knowing that philanthropy is one of our most precious resources, it's in short supply, is very important. And so being honest about what to use when. And then the third lesson is integrate. And we'll now go deeper on this after I pass it back to Najada. But in this example, which was the Forest Resiliency Bond, it was closed a few years ago on the west coast of the United States and was to finance upfront preventative clear cutting to reduce the occurrence and intensity of forest fires. And what we saw through this transaction is we did not have all the stakeholders at the table from the beginning. We had the watershed, the public utility, we had the implementers, the NGO that was going to be actually clear cutting the forest. We had some philanthropy, but we didn't have the private or public capital. And that came in much later, after a lot of structuring, a lot of work had been done. And the challenge there is then there was not a good fit for what private capital was seeking. The structure wasn't quite tailored to support the needs that private capital has. And so what we've learned over time is bringing everyone around the table early, even if it's early in the transaction and the rules aren't well defined yet, there might not be a lot for everyone to do, is a great way to go, because then everyone gets on the same page and you're building something that can work for all. Najada, I'll pass it to you to add more color.
Thank you, Jen. The only thing that I would add is the importance, and it cuts across these three lessons as well, but it's the importance of having essentially a multilingual party engage in these conversations. Blended finance, the practice of blended finance is both relatively simple, but then it becomes complex as you started to put those pieces of the puzzle together in purpose and can get to scale. And I think this ties to the examples that Jen and I will share later. But I have benefited from, of course, working previously under like the broader kind of private impact capital markets umbrella, and then now still focus on the investment side, but under a foundation. What I've come to understand is that essentially there is a gap of understanding between how you can use grant making in order to leverage additional capital to get to the scale that we need from an impact perspective, and then vice versa, how you can use private capital in order to, and those type of structures that we're putting together, but how can we educate those grant makers in a way that they understand the value and the proposition of their capital they're bringing to the table. So having a multi-layer, like Calvert Impact Capital has played this role in several transactions, that understands the needs of different players and can speak to those various needs in an informative way is super important in getting essentially done. A term comes to mind, and Jen will laugh. One of our partners at Lion's Head, which is an investment firm, had said to us at some point, everybody wants blending, but nobody wants to blend. And that really translates to, like what I was saying, that there is the interest, but there is also those barriers that at times we tend to overcomplicate structures, and that comes because different players do not understand how capital in order to bring different types of players and their capital to maximize the impact around the table. Jen, over to you.
Excellent. And what Najada was just talking about is, I think, if Gayle was feeling like herself, she would come in and say, that's what we talk about at Social Finance, is really how we, the lost in translation, and how we connect with each other and find each other and communicate with each other so we can get to good outcomes. So Najada and I wanted to just walk through one transaction and then open up the floor to your questions that we worked on together over the last 12 to 18 months. And this transaction focuses on the need for capital that was made abundantly clear after COVID hit in the United States in March 2020, as they were having to shut down and their liquidity dried up, the banks kind of pulled out and they had no access to capital. This is what we saw from Calvert Impact Capital, and as was others, is that we had the government then stepping in and providing what they called PPP loans. They were recovery loans. They were loans to help businesses make it through this time when they were closed down, the economy was closed down, so that they could reopen and be strong once we did come back. And what we saw, if you look at the graphic on the left, is that the larger businesses, these larger boxes that are illustrated at the top, were benefiting from those traditional public policies. The capital that the government had allocated, they were reaching small businesses through traditional commercial banks. So Bank of America, JP Morgan, Wells Fargo were receiving funds from the government. Small businesses would apply to these banks and they would receive a loan. What we saw, therefore, is if you go down to the bottom of that graphic where the boxes get small and the number of employees goes below 20 people, is these types of businesses do not have existing banking relationships with a Bank of America, Wells Fargo, or another large commercial bank. And so they were not able to access these critical government relief funds. And what we saw is that they were going to disappear, that we were at great risk as a society from losing a whole swath of our community because they would not live to see another day. And so at Calvert Impact Capital, we partnered with many organizations. This was not us alone. We partnered with community development financial institutions, which is a whole universe of unregulated banks across the United States. There's over 1,000 of them, and they're built to serve small businesses, businesses that are traditionally left out of capital markets, businesses led by women, businesses led by people of color, businesses in rural communities. And we looked at them, looked to partner with them. We looked to governments, we looked to philanthropy, we looked to corporates who had at times a lot of liquidity sitting on their balance sheet and we thought could be likely supporters of the need for capital that we saw from these smallest of businesses. And what we did through collaboration was quickly stand up a blended finance vehicle. And this blended finance vehicle, this one is illustrative of the one that was set up and launched in the southern United States, covering 15 states of that geographic region, is we set up a vehicle that would buy loans off of these community development financial institution balance sheets. So when you look at this graphic and you see the 4 boxes that say originating CDFIs, that's what this blended finance vehicle was set up to do, was buy loans off of the balance sheets of those unregulated banks so that they could do more lending in their community and get more capital into the hands of the smallest businesses, who they, as I mentioned before, were built to serve, already had existing relationships. They were just simply capital constrained. And so this SOAR fund, the $163 million that you see there for, is really a liquidity vehicle. It was set up to act like a secondary market, to buy these loans and to therefore put fresh capital in the hands of the CDFIs. You can see the structure that we set up. There's a Class A senior debt tranche, a Class B subordinate debt tranche, an equity and a loan loss reserve tranche, really built off the back of grants or recoverable grants or state or local money, public resources. And it was really important in here to get all the tranching sized right and the rates of returns to the investors priced right, because the businesses where the capital was eventually flowing to were very rate sensitive. This is a time when they're not earning money, so they couldn't pay interest. So we needed very low market price capital. So that's the math equation that's going behind why you see this tranched as it is. One last comment I'll make, and then I'll pass it to Najada, is our role at Calvert Impact Capital was that as an arranger. So we structured this vehicle, we set it up, and we took on the role of raising all the capital. Administered by LISC, that's the Local Initiative Support Corporation. They are a national CDFI in the United States. You'll see they're highlighted under in that red box. They're the fund administrator. So they will be the one that will manage this fund over the life. And there's a third party here that played a very vital role that isn't on this graphic, but another national CDFI called the Community Reinvestment Fund, CRF, based in Minneapolis. They played a very important role bringing a technology platform to this whole vehicle. And I can share more about that and the role of technology, but what they enabled is to create a way for small businesses to go online, fill out an application, and efficiently be connected with a CDFI. As people might know, these were average loans of $10,000. So you need to use technology, we found, in administering smaller loans to really make it economic to do that work. So I'm going to pass it to Najada. They were investors in these funds, so she can speak from her point of view what attracted them and why.
Yeah, thank you, Jen. I absolutely think this example, as well as a few of the other funds that were structured across different states in the United States, the California Rebuilding Fund, as well as the New York Loan Fund, they capture that need of and importance of utilizing different sources of capital in order to get as much liquidity and capital as possible to underserved communities, as well as underserved businesses, in this case, the smallest of those businesses, in particular, to also perhaps share with the team and with the here as well. The reason why we were very excited about this opportunity is twofold. First, because it creates that market change and systems change needed as it relates to access to financing for small businesses. As Jen mentioned, essentially, community development finance institutions are the front line. Are the front line and the that are providing the types of loans needed to small businesses. They are constrained, given that the majority of them are nonprofit lenders. They're constrained by their balance sheet. So thinking about creating a secondary market does unlock capital at scale for these organizations that then translates to additional capital being channeled to the small businesses on the ground. So that kind of like systems change, that sector groundbreaking new product was really interesting and attracting to us. The second piece was really, as a foundation, of course, we look at all opportunities with with the impact lens. Specifically in the South, you will in the US, at least probably regions in the US flows in the South. Lastly, it ties a little bit to what I spoke earlier, which is the importance of combining both grant making and investments in order to create solutions at scale, and in this case, solutions for small businesses and for the CDFIs that are serving the small businesses. We, for the California Rebuilding Fund, which is similar to the structure that Jen is sharing here on the slide, we partnered with the state, which came in at kind of like they the entire position into the Class B shares as a mezzanine investor that comes from the slide. We're looking at a grant opportunity in the equity tranche to deliver then fund additionally to provide additional capital to the small businesses, as well as a Class B investment in the fund, really utilizing the both capital running. The last I'll mention, Jen, here, and I alluded to my earlier comment. I can't stress enough the importance of having a multilingual party think about how you structure these facilities, not so that they only make sense from a financial perspective, but also from an impact perspective. And what I mean by that is, how do you pair then, in addition to financing, how do you pair technical assistance? How do you provide small businesses with a holistic approach of product and services that they need in order to thrive and become more resilient in this economy?
Excellent. Najada, we're losing you now and then. I don't know if you're hearing it, but just so you know, it might be the corner you're in. But
okay,
yeah.
Over to you, Jen.
Thank you. And so, Gayle, I don't know if you're up for it, or Layla, but Gayle, questions or any thoughts that you wanted to layer on top before we go to questions?
I think it's really important that we talk about, there are a couple of things that have come up in the chat box around, and Layla, I'm going to let you answer these questions or ask the questions to Jen. I think that the piece for me is, where does community fit in deal making? Often you've got deals that come in from the top. A funder may think this is an idea is cool, but not necessarily have a real understanding of what community needs are and how capital can be used to meet those needs. So as we think about the equation of where community fits in those negotiations, I want you to touch on that. And then Layla, I'm going to have you go ahead and answer, ask the questions. They're robust and wonderful. So, and then I'm going to sign off. But Jen, if you want to talk about community, and then Layla, thanks for asking the questions that come in.
Thank you, Gayle. So as we shared through this one example about the small businesses and the whole theory of change of why we set up that blended finance vehicle, it speaks directly to community. The piece that perhaps wasn't emphasized as much is ensuring that we are acting in the best interest of community, which means not assuming what community needs, but going out and asking. And so we spent a lot of time with the CDFIs and the CDFIs with their borrowers, the small businesses, asking about rate, what type of loan structure, what return works for you, how much interest forgiveness makes sense. And that was an iterative process for us to then put into the structure and to determine the ultimate economics to the investors. And so that's a microcosm of community, but just a very underscoring the importance of ensuring that community voice is engaged, because often the intermediaries, the investors in these blended finance deals are not in the community, are not touching the community. And so it's really important that that happens. Layla, we'll probably touch on that theme more, but I'll pass it to you for the questions.
Oh, thanks, Jen. We do have quite a lot of questions coming through. The first one from Stefan. What do you think about the EIB and EU-backed European Social Innovation and Impact Fund in this respect? Example, to invest part of the foundation's endowment in social innovators to generate SROI and ROI at the same time.
Najada, feel free to jump in. I know you're in Europe now. If you feel like you have a better handle on this, I'm just reflecting on the question.
Yeah, unfortunately, I'm not aware of the specific example. Jen. So I may need to pass it on back to you and reflect further.
Yeah, and I'm reflecting it on too, because I'm not, I'm not close enough to that work to have a deep opinion. So yeah, we'll Layla, I'm sorry. Let me just think about that a little bit more and come back to it if we can move on.
Absolutely, absolutely. We'll get back to you, Stefan. Another question came from your slides, Jen, for lesson 3. This is from Tanuja. And the question is, what exactly is being funded? What businesses, initiatives, etc., are being invested in? Where is the know-how on how to suppress forest fires?
So on slide 3 in the Forest Resiliency Bond, the know-how how to suppress forest fires came from the U.S. Forest Service. And then a NGO, the nonprofit, it's called NFF. I got to remember what the acronym means, but they are an NGO that does this. They go into forest and they clear cut and they reduce forest fire. So it was the operators, the people that were doing it in the U.S. Forest Service that had kind of the forest, not to use a pun, but the higher view of the whole system to know where to address and clear cut to have the greatest impact and to create some mitigation. Because the reality is the need to clear cut and the amount of capital needed to do this clear cutting is way more than what's available right now. There isn't as much budget being set aside from public sources to do the work that needs to be done. And so this bond, it was small. It was a drop in the bucket. It was only $4 million. And it was to really demonstrate what we could do if you prepaid for the work of clear cutting the forest. And the payer was actually the water authority because they saw benefits to a reduction in forest fires through cleaner water. And so less expense they would have to make in treating water for their service area. So that's the highest level of what was happening there.
Great, thank you. We've got some more questions coming through. If we don't get them in this session, we will get back to you after the session. Next one is from Louis. Do you see a conflict or too many cooks in the kitchen type of situation of how many are too many financiers if you need and what 2 separate orgs can bring, i.e. grant from donor or foundation versus equity from impact investor? It sounds like some foundations like Visa may do both grant plus offer other financial mechanisms, but as they can do both, do they see issues, extra transaction costs, working with other orgs? I hope this is clear.
Najada, would you want to take a stab at that one?
Yeah, I'll start, Jen, and then I'll pass it on to you. So, as I think we have to keep, as Gayle in the very beginning of her presentation showed the spectrum, the different, kind of like the almost kind of like the capital continuum as it relates from grant to investments. Grant making, as I mentioned, is a separate pool of capital that is allocated to not only catalyzing additional investments, right? Like we use grant making for other purposes as well. So like providing technical assistance to service providers, in, let's say, like in the sustainable agriculture value chain that support women co-ops. So I'm giving just an example in terms of like there is other areas that need grant making that is not only related to then utilizing that source of capital in order to unlock or crowd in additional private capital to the table. So that's one piece. The second piece is how do we think about, since we are making and essentially grants have inherently the ability to take more risks, right? Because you are just assuming that that grant doesn't essentially, even if it's written off, that's okay, it has served its purpose. Similarly, when you think about kind of like the risk spectrum from equity to debt, equity transactions also also have a high level of risk. So from the investment side of the foundation, you could assume that as we're making equity investments in funds or in intermediaries, we're taking additional risk. We are thinking as we make decisions whether we're utilizing grants or investments, and in this case equity investments, they go through a very different process of underwriting. They go also through a very different process of approvals, decision making, etc. And so there are, from our perspective, there is no conflict of interest because we have aligned a clear pathway to when we utilize grants versus when we're using investments. Creating those clear pathways and also when you're using one investment versus the other is really important. And then the last thing that I would say is on the pure investment side, we are as you are making, for example, as we're making an equity investment as an LP in a fund that is not, like it is kind of like from a waterfall perspective, all investors are on a pari passu basis. We're trying to stress test for the ability of that capital to come back to us full principal the level of return that we're expecting. Again, on the grant making side, we are primarily not expecting that pool of capital to go back, but essentially just be utilized to de-risk the transaction and really scale the impact. That's the goal. Jenn, I'll pause here and see if you have other thoughts.
I think that was great. And then just looking at the time, wanting to leave you 5 minutes at the end, Layla, maybe one more question.
Yes, thank you. One more question and we'll try and take the rest offline. They are really fantastic questions coming through. Thanks, everyone. Next one here is from Pawan. Are there any successful examples of involvement in blended finance with small Aboriginal communities rather than small businesses?
So yes, across the globe there are. And I would just say, I can steer you to them if you like them, like to see more, but in Canada and the United States, I'm not as familiar with, Australia and some other areas down in Latin America there are. So there is. And what I find is the hindering ingredient, back to, I think the question before, are there too many cooks in the kitchen? You kind of need different cooks in the kitchen to make these deals happen, is there often isn't a intermediary that works close to the community that is able to also speak to the capital markets or reach grant makers and bridge that gap. I see that as a growing space that's being filled now with some very specialized intermediaries that are doing tremendous work. And so I think that that's exciting to see, because once you get kind of, if you think about it as pipes, all the pipes built out from investor to intermediary to the community, then the money will flow. And so in some cases, what I've seen over the last decade is that last piece of the pipe is getting built, but it just needs to get replicated or extended so we reach more people.
Brilliant. Thanks, Jenn.
And so Layla, I know you need time at the end, so maybe it's best to pass it back to you. Your call if we have room for one more question or not.
Let's take a look. All right, we'll try and get to these amazing questions offline if we can. Just to kind of wrap up, to give you guys all some contact details to reach me, it would be great if, Grace, you could put up my slide with my contact details. But I really just wanted to say thank you to Gayle for being such a trooper and getting onto this webinar. And of course, Jenn and Najada. It is, what a way to wrap up a two-part series on social finance. If you missed part one, that also featured Joan Larea, CEO of Conversions. So please reach out and we can send you that recording. It is really worth a watch. These webinars go into the deep topics and offer you a view of what our social finance program experience will be about. So I encourage you to reach out to me to discuss this or any of our social impact programs further. The offerings, to list a few, would be a deep dive into the topics, the experts and practitioners, and the amazing network and community. So please do reach out. My details should hopefully be on the screen now, and I hope to see you on one of our programs soon. Thanks everyone, and thanks again, Jenn, for leading the way.
Thank you. It was always a pleasure. Bye now.
Bye everyone. Thanks.
Thank you, everyone.